Hey, Dan Passarelli here. Well, the market was off just a smidge today, 0.13%. No big whoop, as I used to say when I was in third grade. That's largely, I think, because NVIDIA was off about 1.3% today. We have some news coming out this week. We have PCE, the Fed's favorite inflation indicator, as well as a couple of speakers tomorrow. That's a big thing. And then let's see here. The end of this week, this is the first Friday of the month here. Hold on a second. Let me check my calendar. This is the first Friday of the month, but on my calendar, I don't see the monthly unemployment. Well, that's weird. Is that coming out next week? Huh. Usually it's the first Friday of the month. Go figure. So I guess this, according to my information here, we're not going to have the monthly unemployment on the first Friday of the month this month. Okay, well, no big deal. We do have some Fed speakers, like I mentioned, but really, to me, what the biggest thing is volatility. Take a look at the VIX. So the VIX is 13.84, and that is with just a huge march in the S&P 500 over the past 6 months. You typically don't see this. Usually when the S&P 500 climbs that high, volatility is in the toilet, trading 11, 10, or even in the single digits sometimes. Why is implied volatility so high? Well, I'm going to tell you why. It's because of NVIDIA. Now that might seem strange, might seem counterintuitive, but stay with me. So there are volatility arbitrageurs who trade what are called dispersion models, where they basically trade the volatility of a basket, in this case the S&P 500, in comparison to all its components, or at least most of its components. And when the volatility of the components rise, the volatility of the basket should rise. In this case, when one stock has so much influence, NVIDIA, and its implied volatility is high, and let's take a look at a chart of NVIDIA, a volatility chart to be sure. That is slightly in the top half of the 6-month range, but this doesn't really tell the whole story. What really tells the whole story is if we go to about the 29-day options, because those volatility charts and the VIX are based on a 30-day volatility, and we look at the volatility skew, we see something interesting. We see the at-the-money volatility here. In fact, let's expand this out to more strikes. We see the at-the-money volatility here is 42.71. If we go way in the money, $45 in the money, which is about 5%, the volatility is about the same. Now, usually the lower strike volatility is higher. If we go about the same number of strikes, about $45 to the upside out of the money calls, the implied volatility is actually higher. This you typically don't see. You usually see higher volatility with the lower strikes, lower volatility with the higher strikes. But that's not what we're seeing. We're seeing this inverted skew, a skew to the upside calls. And why is that? Because NVIDIA, if you want to buy 100 shares of NVIDIA, it's going to cost you $77,000 right now. So retail people are just doing nothing but buying calls, buying upside out of the money calls because they're, compared to the stock, cheap. And it's their only access to a bullish play in this stock. So what that does is it makes NVIDIA's volatility look a little higher in some ways, especially to the upside, and that translates into somewhat of a higher VIX. So I thought I'd share that with you as at least something to think about when you're making your decisions in what to trade and how to trade it, especially from a volatility perspective. I hope that helps. This is Dan Passarelli, Trade Smart.